We're going to go through money, monetary policy, taxes, and fiscal policy today. Macroeconomic intervention. So macroeconomics, we're talking about the economy as a whole. As we discussed in macroeconomics, the government must sometimes intervene to help stabilize the economy. What are some different ways the government can impact demand in the economy? So they shake want to try. Sure. So what are some different ways that the government can impact demand in the entire economy?
Imposing taxes, putting some restriction over some product or services.
That's great. Yeah, excellent. Excellent. That's great. Great job. Great job. And then, Dara, do you want to answer that question too? What are some different ways the government can impact demand in the entire economy? Taxes, subsidies. Yeah, subsidies are a good one. It's great, Noreen. Yeah, subsidies, taxes, excellent. Yeah. So subsidies would grow the economy. Excellent. Great job. Great job. Import export restrictions, that's really good. Yeah, so export restrictions would shrink the economy. Import restrictions would grow the economy. Barriers to trade, yes, that could change output. Barriers to trade changes output. Yep, excellent. That's great. Those are good ideas. Yeah, great ideas. We'll learn a lot more about these ideas in this lecture today. So we're gonna go deeper into more ideas on how output changes. So money. What is money? So history of money. Bartering is trading goods for goods. So it requires a double coincidence of wants, which means each person needs to want what the other person has. So commodity money is currency with its own intrinsic value. So including cows, silvers, and etc. And then coinage, precious metals, paper was first found in China. Becomes acceptable as we get more and more used to the idea that money is a thing that helps transactions and doesn't need to be useful in of itself. So what happens is money switched over time. Kublai Khan adopted fiat money in the Mongol Empire during the 13th century. So fiat money is money that's guaranteed by the government. So it's the Canadian dollar is fiat money. It's guaranteed by the Canadian government and the Bank of Canada. And then in Mesopotamia, 3000 BC, the shekel was used as a unit of currency. A unit of barley of a certain rate would equal a certain value of gold or silver. So they used to have back then gold. The currency was backed by gold. So the gold was used as a guarantee for the currency, so you could exchange the currency for gold. And then 13th century Marco Polo brings promissory notes from China to Europe. So what they did was they created what happened was people traded gold. They brought their gold into a bank, then the bank would give them paper as a receipt for the gold that they brought in, and the receipt paper for the gold became cash. So that's how cash originated. That's why we use paper cash, because they used to bring in gold into banks, and then the banks would give them a receipt just to show that they own the gold that was provided to the bank. And then in 1971, President Nixon canceled the convertibility of the U.S. dollar to gold, so that provided the U.S. with more flexibility. They could print money, uh, just to uh, they could print money, and that benefited their economy in terms of the government could just borrow from the central bank and the central bank would print money to lend to the government, and that would be used to pay off government debt and find it and pay for government programs. So that provided more flexibility. The problem was that the currency didn't have an underlying asset anymore. Like the gold provided security because gold is very valuable. And if you could convert the currency to gold, that would make the currency valuable. But it still has value because the US dollar is backed by the US government and the US Treasury. So it still has a lot of security because the government guarantees it. So that's really where it comes from, like not just gold. Like without gold, it's still backed by the government. So that's really important to people. So functions of money. So functions of money. Money is medium of exchange. We exchange money for goods and services is widely accepted. Measure of value. We can compare the value of various goods using money, and store value. Money can be saved and used at a later time. So those are the uses of money. So characteristics of money. For money to be accepted, it should be portable, durable, divisible, recognizable, accepted, and protected from counterfeit. So we'll do this activity here. So which of the following items fulfill the functions and characteristics of money? Put a check mark if they do and next if they don't. For cows, which of these up here could cows meet? Like, could they be a medium of exchange? Could they be a measure of value? Could be a store of value, portable, durable, etc. So does Crizzle want to try? And if someone doesn't answer, anyone can jump in and answer. So for cows, I would say good, excellent. So cows are portable. Yes, that's great. Portable. What about any other? Would they meet any of the other characteristics here? Divisible. Yeah, like if like one cow instead of five, etc. Yeah. Anything else? Any other characteristics? Yeah, durable. That's good. Yeah, excellent. What else? Recognizable. Yes. What about anything else? So I would say it wouldn't be a medium of exchange. It wouldn't be a measure of value because yeah, and then widely accepted, not really, because only farms really can accept cows. So that would make sense. And then what about silver coins? Which ones would they meet here? Does does Sithy want to try? Yeah, I'd agree. That's good. Yeah, I agree. Every one of these would be met by silver coins. That's why we use coins as currency because it would meet all these characteristics. So so that's why. So yeah, so paper money would meet all these also. So yeah. So so like since silver coins meet every characteristic of money, we use it as money. So that's why. So it meets everything we want in the money. That's why it's money. Yeah, exactly. That's great. And then what about flowers? What characteristics would flowers meet, if any? Yeah, portable, recognizable, portable, durable, divisible, recognizable. Yeah. Yeah, do you think it would meet any of the other characteristics? So yeah, I wouldn't think it would meet any of the other characteristics. People wouldn't want to trade for it. It's not really a tradable thing. And it wouldn't be a store of value because flowers don't live that long. Also, they're not really widely accepted. So yeah. And also so plastic water bottle. Which characteristics would a plastic water bottle meet? Portable, recognizable, durable. Yes, that's yeah, exactly right. So portable, durable, recognizable. What about any other characteristics? Any other characteristics?
Would it be a medium of exchange, like when you trade in the bottles for cash?
Yes, I agree. Like there could be like diamonds on them. There are some really nice water bottles. It could be like a gold water bottle. It could be, precious metal water bottle. Uh, Yeah, like it could be a precious metal, like even a silver water bottle, right? It could be a medium exchange for sure. Um, oh, so it said plastic here, but maybe there's like diamonds on the plastic, so we could assume that. So it could have diamonds on the plastic, maybe silver on the plastic, maybe there could be some metal coating that the metal would be expensive and useful. It could have a cool design. It could be an art symbol. Like it could be art, and art is valuable. So if the plastic water bottle was similar to an art piece, would that be part of any of the other categories here? So it may be a measure of value depending on if it's an art piece or it has metal on it, like silver, gold, crusted plastic, let's say. I wouldn't say it's divisible, not really. It's like one water bottle, it can be really divided. And while except not really. There would be some, like maybe art dealers would like it, let's say. And then let's diamonds. What about diamonds? Which characteristics would diamonds meet here? Yeah, like it would meet a lot of these here. Yeah, exactly. Portable, store value, visible, recognizable. Any other characteristics would meet? Yeah, durable. Diamonds don't really get damaged. Yeah, it could be medium exchange. Would it be widely accepted?
Yes, sir.
Yes. Yeah, exactly. That's great. Good job, everyone. That's great activity. So I'll send everyone this screenshot just because yeah, it's a good exercise to do. So now you know why we use coins and paper for money, because they really meet all the characteristics we need for money. Yeah, so it makes sense why we use it. So good job, everyone. So the transition, so coins to paper money. The so people began to take their coins, which are heavy and easy to steal, and put them in banks. Banks then gave people receipts, and thus paper money was born. So, like I said, they put gold coins in the bank, and then banks gave people receipts. So paper money used to be just receipts, and then just turned into money. And there were the gold coins were gone. Like we never had gold coins anymore. We just used paper. So the next step, banks had lots of gold in their vaults. People didn't actually pick up all their gold at any one time. So what is the bank to do? They loan out money in this case. So banks let people borrow money to make profit off the interest. This requires people to not take out all the money they deposit. So the cost of borrowing or the reward for saving. So if I want to borrow $100 at 10% interest, then I will have to pay back $110. If I want to save $100 at 10% interest, after a year, I will have $110. So banks want people to deposit their money and save it. Why? Because when people deposit their money, the bank can lend that money out and loan it out to other people. So people can't borrow money for free. So they have to pay interest. And that's the extra money people pay to the bank. So the bank earns interest every time people borrow money. And then a bank run is when people panic and try to get all their money out at the same time. And this is when they just pull out their money from the bank because they're afraid the bank's going to go bankrupt. But the problem is the banks lent out all that money to other people. So the banks lent out all that money to other people, and it's not in the bank anymore. So the bank has to. So if people want their money back from the bank has to borrow from the Bank of Canada or other banks to pay the customers off because the bank has lent the deposits out to borrowers, and the money isn't in the bank right now. So that's how the banking system works. And because the bank lends out all deposits, almost all deposits. Central bank is born. Central bank is a bank that provides banking services for the government and commercial banks. Commercial banks provide services to citizens such as saving, borrowing, mortgages, etc. So the central bank is a banker to commercial banks, so loans banks money in case of bank runs. They do not provide services to citizens. They issue currency and manage foreign reserves. Central bank controls monetary policy on behalf of the government. So how do commercial banks affect money supply? Even though these banks don't have the right to print money, these banks can create money. But how? This lies in the fact that people will not want all their money at one time. Otherwise, why put it into a bank at all? So they do this for credit creation. So what happens is, like in this case, let's say John deposits $1,000 into the bank. The bank has to keep $100 in their reserves, and they loan out the other 900 to other people. So the bank loans that $900 to the local business owner, who buys the $900 of materials from Lucy, and Lucy takes the $900 she earned from selling materials and puts it in the bank. Bank keeps 10% of Lucy's deposit, $90, and loans out the other 90%, $810 to a driver who puts new tires on his car. So the tire salesman just earned $810 from selling tires to the car. He deposits this into the bank, and the bank keeps 10% of this deposit and loans out the other $729. So here, the amount of money, so like the money supply starts at 1,000, then it increases to, so in this case, it increases to from 1,000 to 1,000 plus 900 plus 810, basically. So it just keeps increasing. So like by then 729. So it just keeps increasing. So 1900, 2710, 34, 39. So like this is the amount of money. So it increases to 34, 39. So it goes from 1,000 to 34, 39. So that's how the banks create money. This is how banks create money, through lending. So that's how it works in the banking system. It's yeah, it keeps going like this until there's no more money to be lent out by the bank. So all this money is created pretty much out of thin air, basically. So this here is kind of beyond the scope of the course, but so limitations, the money multiplier equation assumes that all excess reserves get translated into new loans. However, amount of people such businesses looking for loans might be as small as people save. Type of people looking for loans might not be the people the bank wants to loan to. So monetary policy. Monetary policy is when the central bank impacts the money supply and interest rates. Monetary policy is so the purpose of monetary policy is to impact aggregate demands. The central bank changes interest rates and the money supply to either encourage spending and increase AD, or discourage spending and decrease AD. So in order to So in this case, if the government wants to decrease demand, they order the central bank to decrease the money supply and increase interest rates and increase the reserve ratio. So that's what they do. So that's exactly what they do to decrease demand. So they did this in 2022. So the government, so they did this. They did this in 2022 to bring down inflation in Canada. So this is important to keep prices low. So like this is how they can keep prices low in this case. So interest rate is the cost of borrowing or the reward for saving. So the interest rate determines how much people will borrow and save. So if the interest rate is high, it's expensive to borrow because you will have to pay back more money. If the interest rate is high, it's a great time to save because you're saving more money, because you're earning more money on interest. And then if the interest rate is low, it is cheap to borrow because you don't have to pay back as much money. If the interest rate is low, it's a bad time to save because you are not earning much interest. So I'll put this in the chat here. So here it is. So you want to, if the interest rate is high, it's hard to borrow because you're paying more interest. And then if the interest rate is high, it's a great time to save because you're earning more interest. And then if the interest rate is low, it's cheap to borrow because you don't have to pay as much money. If the interest rate is low, it's a bad time to save because you're not earning much interest. So how can the central bank use this information to increase or decrease aggregate demand? So I'll ask the class this question here. So does Max, you want to try this one? So in this case, they raised the interest rate to reduce aggregate demand, and they lower the interest rate to increase aggregate demand. Yeah, so that's what they would do here. So in this case, expansionary monetary policy is when it's used during times of recession to help boost the economy. So they decrease interest rates to encourage people to borrow and spend, therefore increasing aggregate demand, and increase the money supply, make more money available to people, therefore increasing aggregate demand. So they do that. So this is what they do to boost the economy. This is called expansionary monetary policy. So they can, so to grow the economy, to grow the economy, they decrease interest rates and increase the money supply. So that's what they do to grow the economy. And they usually use this at the trough to help boost the economy into recovery/expansion. So they usually use it at the trough or recession/contraction. So they usually do this at the trough or recession/contraction. So that's what they do to bring the economy out of recession/trough. And then so expansionary monetary policy can stimulate the prosperity cycle. So it can increase aggregate demand, increase production, that leads to greater levels of employment, that leads to increased income, increased consumption, and higher aggregate demand. So it keeps going in that circle here. So it keeps going and going and going like this. It leads into higher aggregate demand, higher production, higher employment, higher income, and higher consumption. So expansionary monetary policy happens through buying government bonds and other securities. So government bonds are a way governments borrow money from banks and investors. They sell bonds, investment opportunity to investors, and banks receive money in return. Investors and banks loan governments money because they expect to receive the principal initially invested amount back with interest, just like any other loan. When government buys a bond back, they're turning the bond back into cash, i.e. putting the cash back into the hands of citizens. This increases the money supply and therefore increases aggregate demand. Cash ends up back in the banking system and multiplies through the money multiplier and fractional reserve banking system. So lower interest rates, this leads to the public knowing what the bank wants to do. This makes it easier for banks to borrow from the Federal Reserve and makes loans more available. And the central bank can decrease the reserve requirement, and that leads to more loaning of deposits, and that leads to more money creation. So lowering the reserve requirement can increase the money supply. So that's something that they do to increase the money supply. So lowering the reserve requirement is a good way to increase the money supply. And then tight/contractionary monetary policy. So tight monetary policy is done through high inflation to help slow down the economy. So they do this through increasing interest rates and decreasing the money supply. So to bring down inflation, like if prices are too high, you can increase interest rates and decrease the money supply. So this is what they do. So 2022, Canada did this because inflation was too high. So they did this in Canada in 2022 because inflation was too high. And they do this during the peak cycle. So they usually do this during peak to slow down the economy and decrease inflation. Because inflation is way too high and they want to bring it down because it's too high for people. Like people can't afford goods in this case. They're not able to afford like groceries and etc. So that can be problematic in that case. Yeah, because they may not be able to afford food. So you want to bring down inflation in that case. So tight monetary policy can stimulate the recessionary cycle. So they can create a recession through tight monetary policy. So tight monetary policy through increasing interest rates and lowering the money supply. That can lead to lower aggregate demand, decreased production, lower levels of employment, decreased income, and decreased consumption, and then so on and so on. So lower demand, lower production, lower employment, lower income, lower consumption, lower GDP, and so on and so on. So lower everything basically. So how tight monetary policy works. So how they increase interest rates is through selling government bonds. So they do this. So the government sells the government bonds. They take money out of the money supply and replace with the asset. So this is how they reduce the money supply. They reduce the money supply through raise it through selling government bonds. This raises the interest rate. And they sell government bonds to raise the interest rate. So they raise interest rates, and that's how tight monetary policy works. And so this is done, they can do this through increasing the reserve requirement. So they can't loan out as much money, and this shrinks the money multiplier. So can the central bank change the foreign exchange rates to impact aggregate demand? So foreign currency exchange rates, expansionary monetary policy. So if the central bank wants to increase aggregate demand, they can change the foreign currency exchange rate. How? By impacting exports. So remember that exports are one of the components of the aggregate demand formula for expansionary monetary policy. The central bank wants to increase exports. They can do this by decreasing the value of their own currency against another currency. So what they do is they lower the interest rate and increase the money supply. And or reduce the reserve requirement. This lowers the value of the currency, and a lower value currency increases exports because products from our country are cheaper now due to the lower value of the currency. And exports increase, leading to higher demand. So that's GDP. So that's what happens with this. This is what happens. And then foreign currency exchange rates. Contractionary monetary policy. If the central bank wants to decrease aggregate demand, they can change the foreign currency exchange rate. How? By impacting exports. Remember that exports are one of the components of the aggregate demand formula. With contractionary monetary policy, the central bank wants to decrease exports. They can do this through increasing the value of the currency against another currency. So they can do this. So in this case, if they want more imports, if they want to be able to buy more from other countries, they can increase the value of the currency through raising interest rates and reducing money supply. So they can buy more from other countries now because their currency goes farther. So that's what they can do in that case to, yeah. So that's what they can do. So then the goods and services and through income. We're all paying taxes every time we purchase goods and services. The government spends tax money in social services, welfare, infrastructure, healthcare, and education. So types of taxation: income tax, tax on the income, wages, salaries, etc. Corporate income tax, a percentage of a company's annual profits. Sales tax, payable on the purchase of goods, consumption goods and services. Excise tax, specific types of sales tax, usually a fixed amount of goods we don't like socially, e.g. cigarettes. Capital gains tax, tax on the gains from assets such as stocks and appreciation, closely associated with income tax. Property tax, tax on value of buildings and land. So we could design a tax system through benefits received versus ability to pay, and then efficiency versus equity. So categories of taxation. Progressive taxation is when people with higher incomes pay a larger share of their income in tax than households with lower incomes. Proportional tax is all households pay the same share of income as is tax. Regressive tax when households with higher incomes pay a smaller share of their incomes in tax than households with lower incomes. So progressive tax system. With a progressive tax system, the first amount of income is taxed a lower amount than the rest. So your first $10,000 is taxed at 15%. Your next $10,000 to $50,000 is taxed at 20%, and your next $50,000 to $100,000 is taxed at 40%. These are called tax brackets. So a family with taxable income of $27,400 would be taxed as follows. So $1,500 for the first $10,000 with a 15% tax rate, and then 20% at $17,400, which is $3,480. So $1,500 plus $3,480 equals $4,980. So it doesn't sound like any other country would want regressive taxation, because poor people shouldn't be paying a high percentage of their income in taxes than richer people. That wouldn't make any sense. Like, you don't want somebody who's making $10,000 a year pay higher percentage in taxes than somebody who makes $50,000 a year. So tax rates don't equal tax paid. So although these types of taxes are required to be paid, some people don't pay them. This could be illegal or illegal. So offshore banking, clever accounting, tax deductions, children retirement, special savings accounts, donation tuition. So types of budgets. The government brings in money through taxation. Citizens pay various types of taxes, and the government uses this money to provide goods and services to the country, as well as pay off their debt. It's rare to see the government have a balanced budget. So a deficit is when government spending is greater than taxes. Balanced budget is when government spending is equal to taxes, and surplus when government spending is less than taxes. So to balance a deficit budget, you either raise taxes or cut spending. Debt and deficit do not mean the same thing. So deficit is spending is greater than taxes. Debt is money owed to somebody. So deficits, cyclical deficit. The government needs to increase their spending on social services because there has been a decrease in consumption. Therefore, spending is greater than the amount brought in through taxes. Structural deficit. So it's a deficit during periods of economic prosperity. Automatic stabilizers stabilize the economy during recessions. So they can be unemployment insurance, progressive taxation, and other welfare programs. So these things, they adjust the economy in recession, so the economy can grow back to normal. And then fiscal policy. So fiscal policy is when the government impacts government spending and taxes. So fiscal policy is when the government wants to change government spending and taxation. So in a recession, the government will increase government spending and reduce taxes to grow the economy. So the government, in this case, during a recession, the government increases spending and reduces taxes to grow the economy. And then during a peak, the government reduces government spending and increases taxes to bring down inflation and pay off their debt/deficit. So that's what they do during those times of in those different economic times, just to adjust everything. This is what they do. So those are strategies that the government uses to stabilize the economy. So expansionary fiscal policy is used in times of recession to encourage consumer spending. They lower taxes, increase disposable income. They increase government spending to help people suffering in difficult times. So like easy slash expansionary fiscal policy is used in a trough to help boost the economy into recovery slash expansion. They also use this during recessions too. So they increase government spending and reduce taxes to get this done. And then contractionary fiscal policy. It's used in times of inflation to discourage consumer spending. So they raise taxes to decrease disposable income and decrease government spending. So tight slash contractionary fiscal policy is done in the peak to help slow down the economy and decrease inflation. So let's try some practice with fiscal policy here. So what we'll work on is an activity on fiscal policy. So our activities here. So fiscal policy refers to a government's policies on what and what. Does nobody want to try this one? So what's a leakage by the government? Yeah, tax. Tax is a good job. And then what's the other thing here? Yeah, spending. Good job. Good job. And then during periods of economic expansion, a progressive what means that incomes increase, a greater proportion of aggregate income will be collected as tax by the government. Does Pavini want to try? So that'd be tax. So during periods of economic expansion, progressive tax means that as incomes increase, a greater proportion of aggregate income will be collected as tax by the government. So since taxation is a leakage from the economy, it has the effect of limiting the inflationary pressures caused by economic growth. So all governments prepare an annual what, which lays out their plans for taxes and spending policy for the coming year. So does Prashani want to try this one? Yeah, close. So budget. So fiscal policy budget. Good job, Maureen. And then when are they usually updated and revised? Does Cynthia want to try this one?
At the end of the year?
Yes, exactly. End of the year. Great job. That's great. Excellent. And then a budget surplus. What is taxation compared to government spending and a budget surplus? Does Cerrone want to try this one? Yes, taxation is more than government spending. So there's a leakage from the economy causing contractionary pressure. This policy would be appropriate when the economy is operating in what? Like what type of economy should it be in? Does Cerrone want to try this one? Yeah, peak. That's great. And the balanced budget. Balanced budget means taxation and spending are what? Equal. Yes. Good job. And government fiscal policy does not affect aggregate what? Does Dower want to try this one? So supply. It doesn't affect aggregate supply. So this is an appropriate policy during times of economic recovery, where the economy is operating at levels of below the full employment level. So the economy is expanding without government intervention. And then what type of budget is when government spending exceeds taxation? What type of budget would that be under? Does Crystal want to try?
Expansionary? No.
Close. Yeah, so deficit budget. So that would be during that would cause an expansion of the economy for sure. So yeah, the deficit budgets they cause growth in the economy. So good job. So in this case, government spending will exceed taxation. Keynes supports budgeting during times of recession to stimulate economic expansion in this case. Good job. And then during a business cycle, at which time an increase in government spending has a multiplier effect on real GDP. So Keynes argued that deficit budgets are necessary during economic contractions and would be offset by surpluses enjoyed when the economy was in what state of the cycle? Does Ashik want to try? So at peak. A deficit caused by an increase in government spending needed to offset reductions in consumption and investment is called what? Does Maxime want to try this one? So that'd be called an expansionary budget. And any amount spent by government in excess of that required to offset reductions in consumption investment is called a what? Noreen, do you want to try this one? So I would say like a bailout in this case. So it'd be fiscal mismanagement. So good job, everyone. Great work on that. Fiscal versus monetary policy. Fiscal policy is controlled by the government. You can use government spending and taxes to control that. And then monetary policy is controlled by the central bank. Primary tools used are money supply and interest rates. So fiscal and monetary policy limitations. Both are demand side only, cannot impact supply. Expansionary policies cause inflation. Contractionary policies cause unemployment. Fiscal policy, government, there's problems with government corruption, so they could give subsidies to their friends in that case. They could give subsidies to their friends and themselves, slower process. Monetary policy effectiveness in recent years is uncertain, not targeted. So I'll paste this in the chat too. And then recap fiscal versus monetary policy. So this is a great chart. It's on our week here. So it's under weekly resources for fiscal monetary and fiscal policy. But I paste in the chat too. So to expand the economy with monetary policy, you can increase the money supply and decrease interest rates. To contract the economy during monetary policy, you can decrease the money supply and increase interest rates. Then fiscal policy expansionary, you can decrease taxes and increase government spending. Fiscal policy contractionary, you can increase taxes and decrease government spending. So let's practice this here. So 4 actions that can be used at the peak to help slow down the economy and inflation are what? Does Pavani want to try this one? So you can increase the money supply. Decrease the money supply. Increase interest rates. Reduce production, that's a good one. Raise interest rates, yep. Reduce production. Reduce public spending, that's good. Yeah, reduce public spending. Anything else? What else can you do? Raise reserve requirements. Raise taxes. Yeah. Sell government bonds. That's great. Great job, everyone. And then what can you do to boost the economy? Like as a government or central bank? So it can be the opposite of what we said for slowing down the economy. It can be the exact opposite. So increasing the money supply. Yeah, less rate of interest. That's good. That's great. What else?
Increase production.
Excellent. That's great. Increase production. Perfect. Also,
Increase
yeah,
government spending.
yes, increase government spending. Save money and invest it. That's great. Good point there. Saving habits, yeah. Save more and then invest more. That's great. Anything else? So yeah, decrease reserve requirements, reduce taxes, buy government bonds. Yeah. So great job, everyone. Great point. So I'll paste this into the chat. So I'll provide this to everyone. This video here is a good video to watch. I'd recommend watching it after class. So here it is. The other link doesn't work, so I'll send you a link that'll work. So